Welcome back to another episode of Palisade Radio. I'm your host, Karem Mamutlu. And on today's show, we have Mickey Fulp, who's the author and publisher of themercenarygeologist.com. Welcome to the show, Mickey.
Thanks a lot, Karem.
Let's start by talking about the current sentiment within the junior resource space, and let's focus on the gold and silver related junior mining companies. Is what we are seeing today currently reminding you of previous cycles within the junior mining space in regards to perhaps we are now bottoming out? What is your sense?
Well, I think we have bottomed out. We are definitely dependent on the price of metals to continue with what looks like for a couple of years now has been an incipient bull market for commodities, and gold really drives this sector. I think that I have been disappointed in the slowness in development of what I see as a bull market for commodities coming. And of course, once that happens, I think it will be followed by a bull market in the junior resource sector.
Let's move on to copper then. I want to get your thoughts on the recent price action. It's definitely been more positive, and perhaps one reason for this is because there's more awareness surrounding the supply and demand fundamentals for copper and a lack of any meaningful discoveries coming online within the next few years. So does the narrative for electric vehicles and the copper that'll be needed for EVs and energy storage provide an even more bullish scenario for copper going forward? What are your views?
Well, it certainly does, because electricity is copper. So as the world becomes more electrified, the demand for copper will increase. It's increased at an annualized rate of 3.4% a year since 1900, with very little respite. But I must say that the new demands, even in the most bullish scenarios for electric vehicles and energy storage, only provide a small incremental increase in the demand for copper. I think in the best case scenario, you're looking maybe over the next decade or so, an increase of new uses by perhaps 400,000 to 500,000 tons a year. And in a market where annual demand is now approaching 25 million tons a year, that's only maybe 6 or 7 days of annual supply. That said, I am very bullish on the long-term or mid to long-term fundamentals of the copper market. In the short term, I think that's very equivocal. Depends on Trump and Xi making China and the U.S. Kiss and make up and get a trade deal done. That is what has driven the copper market up, 15 cents or so over the last 2 or 3 weeks. But the supply-demand fundamentals right now, as you mentioned, are compelling. There's not a pipeline of copper projects going forward. Inventories are at near record lows right now, world inventories. But here's the deal. The market right now is still in backwardation. I looked today, the front month spread is... Now, bear in mind that there's a rollover of a contract today. So what I'm calling a front month spread is going to be basically a 2-month contract here very quickly, a cent and a half per pound. So that's a significant amount for a spread. And the reason is the speculators, the hedge funds, are largely out of the commodities derivatives markets. And that's problematic. We saw copper speculators, hedge funds, massively long a year ago. They left the market and became massively short in June. So the price dropped 10 to 15%. and now they're completely out of the market. So it's an equivocal market at best in the short term right now.
I want to understand some of the speculation success you've had in the past. Let's talk about some of the most successful speculations and how they occur. When you've bought something that's unloved and forgotten, and then you have the patience to watch a company execute on its plan, is this how success would be generated? And what are the most common mistakes you see the average investor make in the resource space?
Well, you've alluded to this. We employ a contrarian philosophy. Uh, the four uns, as I like to say. So that's unknown, unwanted, unloved, and undervalued. So the key to my speculating, and I refuse to investing, as some people try to do, it's speculation that we do, is the key is getting in early on ideas. We apply a trading methodology that I call the power of two, that demands that you take all your money off the table when a stock doubles. And so then you maintain half your share position, but you use that capital, which you also maintain, to find another stock that will double. And we apply this on a 12-month or less basis. If most junior resource companies, the great majority, with very few exceptions, will have a double from a 52-week low and high. So you want them to buy them at their 52-week low or near that, and sell them at their 52-week high or near that. Most speculators, not investors in the resource space, generally, and we speak to the retail and lay investor, is they buy high and sell low. They buy when stocks are being promoted, and that's not the way to make money. The other common mistake is they buy and hold. These are not hold stocks. You've got to trade them. You got to sell them. So that's one of the problems that the retail lay investors has. The other problem I see is they trade on emotion. It's common knowledge that markets function on greed, fear, and panic. Well, I would say they function on greed and panic, with a commonality being fear. So when people see things going up, they think, I've got to get in on the next big thing, and they get greedy because they fear missing that next big thing. And then when things start going south, as they inevitably do, they panic. And so that's driven by fear too, and they panic and they sell. And that's not a good way to speculate in this sector. A lot of it too has to do with, human beings are basically lazy, if you will. And I'm lazy, but I've learned to do the things that are required to make money. So commonly, lay speculators have a lack of due diligence and research. You should not buy a stock because your brother-in-law told you it was the next hot thing coming, or your barber, or your mechanic, or even your broker. You need to do your own due diligence and research.
Very good. So what are your current thoughts and views on uranium, and what catalysts will it take for uranium to begin another new leg higher? And does this market today in uranium remind you of the beginnings of the previous uranium bull market? And what was your experience of this, if you can share that?
Well, I am sort of a permabull on uranium. And once again, it's the contrarian philosophy that requires patience. So I establish my positions, and my favorite part of this space, which would be U.S. Developers and producers, several years ago, because uranium is coming. The question is when. The catalysts that we have right now are in the U.S. the Section 232 ruling, which I'll explain that a bit. That is a petition by 2 U.S. uranium producers to produce domestic uranium, require U.S. domestic utilities to use 25% of their current needs from U.S. produced uranium. Last year, the U.S. produced 2% of the uranium it used, and most of that came from Kazakhstan, Canada, Australia, but some other bad players in that Kazakhstan realm, which would include Russia and Uzbekistan. We get 40% of our uranium from those three countries, which are not friendly or unstable or they're corrupt. The other catalyst that I see coming is the U.S. utilities contracts, long-term contracts are ending. So we will have a buying cycle soon. And the other thing that what happened in the uranium industry post Fukushima is the producers did not cut back. They continued as demand went down, with fully about 12% of world demand came immediately off the market with a shutdown of 54 Japanese, and the Germans decided they were going to go solar in a place where the sun doesn't shine. So they shut down, I think, 8 reactors and started importing electricity from France, from Alsace, where that electricity is produced by nuclear power, but that's another matter. But the producers did not cut back. They continued to go ahead, driven by Kazakhstan, increasing production. But really, Cameco just kept producing, even though they were losing money. And Paladin in Western Africa, the Rossi mine in Namibia, the Ranger mine in Australia, all losing money, but they didn't cut production. They have cut that production off now. So we're seeing a balancing of the market. Question is when. I'm the wrong person to ask about that because I've been wrong over and over on this. But the uranium market's very opaque, and even the people in the know, the people that I know that are most savvy about the uranium market, guys that have been past presidents, Uranium Producers of America, guys that are really connected in the Washington lobby, they don't really know when it's going to turn. Rest assured, it will return. Does it remind me of the previous uranium bull market? I think that still has to play out. When the price of uranium went from $10 to $135 from 2004 to 2006, that was driven by traders and rampant speculation. There were 600 to 700 uranium companies in junior resource space. I don't see that latter thing happening. But I do see an increase in the price on the horizon. You know, we need $45 a pound in the U.S. to make our cheap ISR uranium economic.
As we finish up here, Mickey, is there anything else you wish to talk about? Perhaps the current strength in gold? Do you believe that this will continue throughout the rest of the year? Or is there anything else you wish to talk about?
Yeah, well, let's talk about gold a bit. What we've seen are the usual seasonal patterns, January to February. You know, we track the commodities. We have gold prices since 1792. We have daily gold prices since 1970. So we do these seasonality charts. Commonly, you see a rise in the gold price of 6 or 8 or even 10% from January to February. We've seen that. Then we expect it to be flat from March to mid-June. Then the summer doldrums, we'll have seasonal lows then. An up market from mid-September to the 1st of November, and then a flat market to mid-December. So year, these patterns have played out very well. on a 20-year record that we're tracking. I am positive on the price of gold for a variety of reasons. Generally weaker world economy, which is good for gold. Geopolitical risk. There are we've got civil wars ongoing in the Middle East. We've got the Saudis and the Turks and their kerfuffle over the last couple of months. Brexit right now. Problems in Brazil, and certainly the pending collapse of the Venezuelan government. Those sort of geopolitical risks are always good for gold as a safe haven. U.S.-China trade talks, that ambivalence right now is good for gold. Central bank buying, we've got the Russians and the Chinese and the Turks and a couple other companies that had record central banks buys last year. And finally, the dovish Fed and the idea now that there may not be more than one interest rate rise in the U.S. In 2019. All those are good for gold.
Okay, well, thank you very much for your time today, Mickey. Much appreciated.
Thanks a lot, Karim, and I look forward to talking to you again.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?